everyone, welcome back to our YouTube channel. मैं हूँ चारू आपके साथ and today we are going to talk about top mid caps to invest in 2021. So we have identified the important mid cap stock in two videos, and each videos will consist of analysis on two good mid caps, and I'll call it हम दो हमारे दो. So मेरे दलाल स्ट्रीट के दोस्तों, if you really like this video, kindly hit the like button and subscribe my channel. So let's begin with the part one. So the first mid cap which we recommend is Heidelberg Cement. So CMP 2020 target price is 502 years on bullish infrastructure growth led momentum. Let's start with the fundamental analysis. So Heidelberg, a German giant, has a cement operations across many parts of India. It's a company with large foreign holding and almost 70% promoter holding and limited debt, which indicates a sound financial health and a perfect balance sheet for someone to invest their money in. Heidelberg Cement India unit reported good set of numbers for a Q2 financial year 2021 with revenue of rupees 5.14 billion, down 1.6% year on year, and EBITDA of rupees 1.26 billion, up 2.6% year on year despite lockdown. The company has backed strong government orders in Uttar Pradesh, and there has been a slight volume decline, but the management expects demand to improve post the festive season in central region in Q3 and Q4. So with the lifting of lockdown restrictions, the demand scenario continued to improve throughout the quarter. Industry volumes in the July-September period surprised positively due to buoyancy in rural markets and resumption of stalled projects. Cement volumes have been resilient owing to an upswing of infrastructure and house activities. The near-term trajectory is likely to be sustained as government spending as well as policy reforms are expected to boost volumes post the festive season. Northern and central regions stand out with realizations and volume remaining firm despite COVID disruptions. Heidelberg Cement, which operates in the central region, is our top pick in mid-cap cement as it has a cash-rich balance sheet, healthy margin profile, and superior return ratios. Long-term investors should look to accumulate this stock during correction. The traders can also trade in this safe stock for earning a 5 to 10 rupees difference every week in such a safe stock. So we maintain our buy rate on this stock. And now the technical analysis. The stock has a tendency to move in a range and give a sustained breakout at regular intervals. It has a rhythm to consolidate in a rectangular pattern for months, and then on occasions a breakout is provided. This is a useful opportunity for traders given the predictability of this stock. One can play for short term by buying at support levels and exiting at resistant levels on a regular basis. Such stable, moving lesser volume stocks are suitable for risk-averse investors and traders who are seeking safe and stable limited return from the stock market. On an overall 5-year chart, it respects the trend line well and consistently bounces back from its support levels and gives a breakout regularly. Such stocks can be termed as a senior citizen stock in my language, which don't fall or rise too much based on market movement, which is indicating too much safety. And we recommend a long-term target of 500 in 2 years depending on infrastructure growth and order momentum continuing. Short-term target can to be played in a range between 210 and 230 on a regular basis till stock trades in this rectangular pattern to make sure 5 to 10% returns on a monthly basis in this stock. And now our next stock is Apollo Tyres. So CMP rupees 200, target rupees 300 in 1 year holding period. And let's begin with the fundamental analysis. Domestic auto industry's volume have been on a steady mend in the months post lifting of lockdown restrictions. Manufacturing and distribution activities have been getting ramped up gradually since June 2020. And we expect healthy growth overall in tire demand over financial year 2021 to 2023 as demand from original equipment like car and manufacturers OEMs is expected to grow at a strong 18 to 20% CAGR during the same period. Higher demand will be seen across all the automobile segment. And post the lockdown, we have seen faster than anticipated recovery in the domestic replacement segment as economic activity has improved. Imports have been restricted and most manufacturers expect a positive revenue growth in financial year 2021. For Apollo Tyres in the replacement market, Q2 of financial year 2021, volume growth was 18% year on year. Apollo Tyres reported a healthy Q2 financial year 21 performance. Total operating income came in at 4,283 crore, up 7.4% year on year. And the company added Kiara Motors as a customer in India and started serving the new Hyundai Creta. In Europe, market share gains in ultra-high performance PCR tires were at 12 BPS, while those in TBR and farm tires were at 25 BPS each. The co added more than 350 Indian dealers and 200 plus Europe dealers in the first half of financial year 2021. So with this strong demand reversal in sight, we should buy this stock at current valuations, pre-assuming COVID-19 goes away and no more troubling lockdowns are imposed. We recommend buying this stock for rupees 200 around and holding it for a period of 1 year for a target above rupees 300. Also, it can be value pay for short-term traders who can buy this stock and sell it for a differential of 3 to 5 rupees per share profit in a span of just a few hours. And now the technical analysis. As per its long time price charts, the stock trades range bound in a rectangular pattern. It keeps making triangle pattern and after a lot of zigzag movements, a post consolidation breakout is seen which is sustainable for the long term, indicating value generated for the shareholders. Apart from these triangular pattern consolidations, periods and a small trend line up or down moves, this stock doesn't offer huge, deep, volatile price movements, which makes it safe for immature traders and freshers also to make in this stock by buying a few hundred shares and selling it in the gain of 5 to 15 rupees within a day or a week's time. This stock may be used for short-term as well as long-term investment purpose. The trendline support and resistance needs to be consistently watched as there is a past where slow correction also is seen, which indicates longer periods of lower RSI. So better exit if a bearish crossover is seen on a monthly or a quarterly price chart. Otherwise, there is a fundamentally sound management and a big brand name. Only that price movement uncertainly is troubling the stock, which some people call expensive due to its rupee 1 face value. And as per our prediction, the stock is suitable to high as well as medium risk investors and will definitely deliver good returns to short-term traders as well. I hope these two stocks in our first edition of Hum Do Hamare Do is helpful to you. Do comment in the YouTube comment section, and if you have any doubts or questions and if you want to say anything about these stocks, do comment in the comment section, guys, and share your feedback about this two mid caps stocks. And don't go anywhere, stay tuned with us. We are coming, and our next segment will be about the part 2 of Hum Do Hamare Do. Thank you.